What if just a few dollars a day could kickstart your journey toward real financial freedom by 2035? That might sound ambitious, but with the right investment strategy, it's entirely possible. In today's video, I'll spotlight the top 5 growth ETFs to watch in 2025, each carefully selected for their explosive long-term potential, innovation, and leadership in the market. Whether you're new to investing or a seasoned pro, I'll break down each ETF's holdings, past performance, sector focus, and how small, regular investments can power your growth portfolio. So why consider growth ETFs? Growth ETFs focus on companies expected to increase in value more quickly than the overall market. These funds emphasize capital appreciation over income, investing heavily in sectors like technology, biotechnology, green energy, and digital infrastructure, areas that drive innovation and economic transformation. While growth ETFs tend to be more volatile and have a higher risk-reward profile than value or dividend-oriented funds, they offer some of the greatest opportunities to build wealth over the long term. Beyond the growth potential, ETFs offer diversification with professional management at lower fees compared to mutual funds. They allow investors a set-it-and-forget-it approach while gaining broad exposure to innovation-focused industries. When considering a growth ETF, key metrics to watch include potential for capital appreciation, historical returns, expense ratio, sector concentration, and volatility, so you can balance growth with your comfort with risk. Here's how to evaluate a great growth ETF. When picking growth ETFs, start by looking at their exposure to future-oriented industries such as cloud computing, biotech breakthroughs, renewable energy, and advanced digital infrastructure. High-quality holdings with strong market positions, disruptive technologies, and significant R&D can be indicators of durability. Check the ETF's assets under management and liquidity to ensure ease of buying and selling. Also, focus on low expense ratios. The lower the fees, the more of your money remains invested. Examine historical growth rates and volatility to understand risk and reward profiles. Diversification is vital. While growth funds often have sector concentration, funds holding too few stocks or overly concentrated themes pose higher risks. Beware of hype around some funds. Not all thematic or high-growth ETFs deliver sustainable returns. Look for consistency in execution, strong management, and reasonable valuation. Now for the exciting part. Based on all those smart criteria we just talked about, here are our top 5 growth ETFs that we believe are perfectly positioned to help you build serious wealth by 2025 and beyond. These are the funds that are not just riding the wave of innovation, but are actively investing in the companies creating that wave. Let's dive in. 1. Invesco QQQ Trust, ticker QQQ. This ETF tracks the Nasdaq 100 index, focusing on top U.S. technology innovators. With a current price around $330, QQQ has returned approximately 60% over the past 5 years, driven by major tech giants like Apple, Microsoft, Amazon, and Nvidia. Its expense ratio is low at 0.2%, with $200+ billion in assets under management, making it highly liquid. QQQ offers exposure primarily to tech and communication services sectors with a standard deviation around 15%, reflecting higher volatility consistent with tech-heavy funds. Investing $10 a day over 30 years in QQQ could potentially grow to a 7-figure portfolio. This fund is ideal for aggressive investors looking for long-term capital appreciation concentrated in technology. 2. ARK Innovation ETF, ticker ARKK. ARKK is one of the most discussed growth ETFs, focusing on disruptive innovation across sectors including genomics, fintech, robotics, and AI. The fund has experienced mixed volatility but has shown a 5-year gain around 18.7%, reflecting its high-risk, high-return profile. ARKK's expense ratio is about 0.75%. Major holdings include Tesla, Roku, Teladoc Health, and CRISPR Therapeutics. Its concentrated portfolio and active management style seek to capture the next big innovators. This ETF suits investors with a long time horizon and appetite for volatility. 3. Vanguard Information Technology ETF, ticker VGT. VGT targets the broad U.S. technology sector with a low expense ratio of 0.1% and $70 billion asset under management or AUM. It tracks the MSCI US Investable Market Information Technology 2550 Index, including big names like Apple, Microsoft, Nvidia, and Adobe. Over the past 5 years, VGT has delivered around 70% returns, offering strong price appreciation and moderate volatility. This ETF is ideal for investors who want broad tech exposure with low cost and diversified risks. 4. iShares Global Clean Energy ETF, ticker ICLN. Capturing the fast-growing clean energy segment, ICLN offers exposure to global companies engaged in solar, wind, and other renewable energies. With an expense ratio of 0.42% and $3 billion AUM, it includes companies like Enphase Energy, Vestas, and Plug Power. While more volatile due to sector-specific risks, ICLN returned approximately 90% over the last 5 years, highlighting rapid growth potential as the green transition accelerates. It's well suited for investors who want thematic exposure to sustainability and climate change solutions. 5. Global X Robotics and Artificial Intelligence ETF, ticker BOTZ. BOTZ focuses on companies involved in robotics and AI across various sectors. Major holdings include Nvidia, Intuitive Surgical, and Keyence Corporation. The ETF carries an expense ratio of 0.68%, with returns near 70% in the last 5 years. The fund combines high growth potential with diversification within cutting-edge technology sectors. It appeals to investors bullish on automation and AI-driven innovation over the coming decades. Picking the right growth ETF depends on your risk tolerance, investment timeframe, and existing portfolio. Growth funds tend to be more volatile, so consider your comfort with market swings and potential drawdowns. For balanced exposure, you might combine a few thematic ETFs with broad market or dividend ETFs for stability. Consistently investing small amounts through dollar-cost averaging reduces timing risk. Reinvest dividends to compound growth, and monitor changing sector trends to rebalance periodically if needed. The key is staying invested and disciplined to harness growth over the years. Building wealth in 2025 and beyond is about harnessing innovation and growth in the world's most dynamic companies. The 5 ETFs showcased, QQQ, ARKK, VGT, ICLN, and BOTZ, each offer compelling opportunities to power wealth creation through diversified exposure to technology, clean energy, and innovation. What's your favorite growth ETF? Drop your thoughts in the comments.